Get ready to learn the best investment strategy for beginners. Ever wondered how to grow wealth consistently, even as a beginner? You're not alone. Meet Sarah, who is stepping into investing for the first time. This isn't just theory, it's the bedrock of my portfolio, delivering impressive growth. Stay tuned as I guide Sarah and you through this proven investment strategy. By the end of this video, Sarah and you will have a clear plan to follow. I put in over 5 years of investing my money to validate this strategy. Let's get started. Many investors find it hard to make their money grow consistently with confidence. I'm David Harbour, and I provide educational content that helps investors overcome obstacles and increase their wealth, allowing them to achieve their financial goals. As a beginner, trying to beat the market is very hard. Even professionals struggle. An article in Forbes Advisory said, actively managed funds do pay for talented people who can pick stocks that outperform. And, despite charging more, 79% of active funds trying to earn a high return underperformed the S&P 500 in 2021. As we learn the best investment strategy for beginners, we will also create an investment plan along the way. This is a document written down on how you plan to invest, aligning to this strategy. Having this written down in advance on what you plan to do and how removes guesswork from investing. A person just getting started in investing should keep this plan simple so you can stick to it. A typical investment plan aligns to your tax year. Here are the core items to have in an investment plan. It is important to think about each item carefully ahead of time and actually write it down. There is power in writing down the answers. Now let's work through each section of the plan with Sarah. I'll show evidence as to why I personally use this strategy. The S&P 500 has a historical average of growth between 9 and 12% depending on the time frame. So 10% is a good amount to aim for when starting out. Under the objective section, write down a specific goal of this investment plan. Some more information about Sarah that will aid us as we write her investment plan. Sarah wrote down, in 2024, I aim to initiate my investment journey, leveraging real-world knowledge to build confidence. Acknowledging the inherent risks of the stock market, I view each as an opportunity for growth and learning. I plan to invest $11,400 from my savings, supplemented by $443 every pay cycle. My first year target is a 10% return, which will serve as a benchmark for my investment strategy. Under the money management section, write down the amount of money you plan to invest in the coming year and when. A core money management activity is establish and maintain an emergency fund, which is generally about 6 months of your pay. Use principal dollar cost averaging to reduce fear and manage emotions. Dollar cost averaging in investing is the same amount of money in a security no matter if its price goes up or down. Factoring in her objective and financial situation, Sarah wrote down, keep $26,600 in a savings account as an emergency fund. This is 6 months of her pay. Use $11,400 from her savings to accelerate her investing. Instead of putting this all in on day one, she will use a principle called dollar cost averaging to help reduce fear and emotion. Contribute 10% of her pay each month. Sarah's been diligent in the past about setting aside 10% of her pay and will now use this $443 to increase her investing portfolio. She included a table of her plan each month. Earlier, I said beating the market is very hard, so instead, ride the market by investing in an exchange-traded fund, or ETF, that follows the S&P 500. Exchange-traded fund, or ETF, is a basket of securities that can be bought or sold like a stock. Index is a measuring tool for tracking changes in a group of items. S&P 500 is an index commonly mentioned in the news, which is the abbreviation for the Standard & Poor's 500. This is an index that measures the performance of 500 of the largest publicly traded companies in the United States. Over the past 20 years, the S&P has had a total gain of 420% and an annual growth rate of 9%. Over the last 10 years, the S&P had an annual growth rate of 12%. The stock index is designed to always go up in the long run. Looking at the S&P 500 index from 1990 to 2023, you can see even major events only had a temporary impact. How can this be true? Let's dig deeper. An index, such as the S&P 500, is comprised of selected companies that meet certain criteria. Companies are supposed to grow over the long term. If a company that is included in the index stops meeting the set criteria, then that company can be removed from the index and replaced by another company that does meet the criteria. This is why the index always goes up. Looking at the past 40 years, the S&P 500 index had a positive gain 77.5% of the time. If we look at a longer time period and group the years by percent gain or lost, you can see big losses are extremely rare. As you can see, investing in the S&P 500 ETF has shown statistically a positive return and diversified. Using this knowledge, in the diversification rules section, Sarah wrote down, invest in the SPDR S&P 500 ETF, ticker SPY, SPY. As Sarah is starting out, she plans to invest only into one ETF. This will provide built-in diversification while she develops her skills in share market. The SPY ETF at the time of this video is spread across these holdings, giving Sarah diversification across sectors and categories. In the watch list, Sarah wrote down ticker SPY. This will keep her focused. For entry rules, she wrote down this. At a support level. Sarah is going to follow the rules strictly in her first year while she builds her confidence. She will only add each month if the SPY ETF is at a support level of either 50-day moving average or 100-day moving average. If the price isn't at one of these levels, then Sarah will wait until the price does. For exit rules, she wrote down this. Don't sell. As Sarah is only buying in the SPY ETF, individual companies not meeting criteria is irrelevant. So in her case, there are no exit rules. This will come later when she starts buying shares of individual companies. For routines, she wrote down this. Sarah's investment plan for the first year is pretty simple, so her routines will also be straightforward. On her payday, Sarah will review the price of the SPY to see if it meets her entry rules. If yes, she will put in a buy order, otherwise, she will assess what the support level should be and set an alert. This will save Sarah from looking at the stock charts all the time. Once the alert is triggered, she'll monitor each day waiting for the SPY to meet her entry rules. On the first day of each month, Sarah will review her portfolio and assess her current tracking to her investment plan. I'd love to hear in the comments below if you follow a written investment plan and if it contains these elements. In conclusion, index funding is the way to go for a beginner. Remember, it's essential to start early, stay consistent, and focus on your long-term financial goals. By embracing index funds, you're laying a solid foundation for your financial future. Successful investing is a journey and not a destination. I provided a link below to my free beginner's guide to investing, so check that out. I urge you to share your thoughts or questions in the comments below and consider subscribing to ensure you don't miss out on future videos on investment tips and strategies. Let's embark on this investment journey together. Until next time, may the markets be with you. I will see you in the next video. Bye!